RC, as well as Deepak Shenoy, founder, Capital Mind, joining in. Gentlemen, thank you for taking the time out. I'm going to come to you first then, Mr. Antony. And, help us understand what prompts companies like yourself to take over stressed assets, and how do you determine the value really in a company?
Value of the company. There are two ways of doing it. One is the quality of business, the robustness of the business of the company. Second is the asset valuation of the company. Primarily when we acquire assets, we look at the business value, because we look at cases where the company is operating, it has EBITDA or EBITDA potential. So we look at the value, because our theme is to revive these companies. These are companies which have temporary, mismatch in cash flow. So our philosophy is to set right this and revive them. So we look at the business valuation. Of course, in the worst case scenario, we need to look at the asset valuation, because there is a remote possibility in any asset resolution, the company can go into liquidation. In that scenario, we should take care of. That's one of our risk assessment measures. So both are important, business valuation as well as the asset valuation.
Okay. Deepak, tell us a little bit about the current set of shareholders who are excited about the bidding war. Is it worthwhile to hold or accumulate?
Not really. I feel that, if you think about it from a pure, first principles point of view, the current shareholders have been, the company is bankrupt. So technically, equity takes the first hit, right? So debt holders will take whatever is in the company, and nothing will be left for equity holders. In that context, what's going to happen right now, I feel at least, and we haven't yet seen a full resolution yet, is that the new buyer will come in and get a significant amount of shares at a very, very low price. The current lenders will get hit, because if you're writing off 75% of your money, you're not just going to give that away. You're going to say, let it be at about, I will convert my whatever I'm writing off into shares. So they will then convert their remaining shareholding into remaining debt into shares. Whatever is the sustainable part of the debt will remain as a debt in the company in the new format. The current holders get diluted 95 to maybe 90 to 95%. So if you're looking at a company and saying, listen, it's 20 rupees only, is it a great buy? I think, the value may be 2 rupees for the current shareholder. It's only when because if a company is 500 crores today, it becomes 5,000 crores in equity value in 2 years. But you've been diluted by 95%, your valuation might still fall by half. So current shareholders have really no reason to believe that they're going to get a phenomenal success out just because the company is being resolved. In fact, it's almost a point where they'll know exactly how much they lose, but they don't probably stand much to gain.
Absolutely. Mr. Anthony, generally a lot of skeletons have been found in such companies, and you only hear it over a period of time as to what are the deepest, darkest details emerging in terms of, unexplained advances, other such irregularities as well. How is it that you deal with such unexpected surprises that come out and spring out so often?
See, when we acquire assets, we acquire loans, we look into these aspects. Actually, if you really look at 8 to 9 lakh crore of NPAs, the fraud element, the fraud or any malfeasance, these cases would not be more than 5 to 10% of the total NPAs. One has to be careful about that when you acquire that. Because as I said, the underlying asset valuation is very important. The cases what we recently saw are, these are all basically trading companies. So when an asset reconstruction company acquires assets, we look at the underlying assets. Trading companies, normally, of course, there are no assets. EPC companies, there are not much of assets. So one has to be careful about them. And I again say, the fraud element in the end, total NPA would not be more than 5 to 10%. So one has to be careful about that. And ARCs, normally we look at the underlying value of the assets. Of course, we give a lot of emphasis on the business value.
Okay, fair point. So how is it that you find operational talent then to run the company? Because I guess in such cases, that would be a very critical aspect.
True. True. In majority of the cases, if I analyze the cases, again, 70 to 80% of the cases, it's a financial re-engineering or a financial appropriate restructuring, maybe right-sizing the debt, conversion of part of debt into equity to correct the debt equity position. If you do a little financial engineering, I think 70-80% of the assets can be brought back to health. You may need additionally, managerial bandwidth, maybe in another 5 to 10% of the companies. That, of course, one good thing that's happening in India is teams are coming for operational capabilities. In fact, we have discussed with a few groups which are trying to, come and operate the company physically. So we are planning to have an operational tie-up with a few groups like that. We have set up an operational turnaround group within us. We want to build that capability within us. I think slowly, I think that capability is being built, and there are agencies available. We have a few agencies even in India. I mean, banks utilize, we have utilized. It's a slow process, but it is getting built up.
Deepak, just wanted to understand from you, there's companies like Amtech, Auto, Bhushan Steel, etc. They're so volatile in terms of the market movement. What do you think the market is really trying to price in terms of talks of a resolution? How would you really place stocks or advise one to place stocks within this space?
So this is interesting because I think there are 3 or 4 big stocks that you're seeing a lot of action in. Bhushan Steel, for instance, the day it was announced that Tata Steel had upped its bid, the stock went up 20% to 55 or something, and now it's back to 40 or 42. This is about, I'm talking 5 days. Amtech Auto has been in upper circuit ever since Liberty House's bid was considered to be the top one. Monnet Ispat saw 1 day of a big move from 24 to 26. It's come back to like 21 now. We did an analysis of Monnet Ispat because that's the only thing where we have some semblance of what's going to happen. There is between 87% and 94% dilution. It seems like because there is a hedge fund involved, they want to keep the company listed and therefore are taking only 75% equity in the first tranche with only 390 crores. The remaining 500 crores will be converted as quasi-equity, its preference shares, optionally and compulsorily convertible. So it's a little bit of financial engineering here and there. The buyers, that's JSW Aeon, will likely see a 4x to 5x return if they're able to revive the company. The banks will see a small amount of return, but mostly they have to write out 75% of the loans from 10,000 crores to only 2,500 crores. And the current shareholders will see dilution up to 90%. Our calculations was that if the company revives to the absolute pinkest of health and steel prices continue to be upbeat for another 2 years, the upside from here is a negative 30%. That means the best case scenario is still down 30% for current shareholders. So I don't know where the valuations are going in terms of what market perception is, but I feel we're going to be in for a rude shock, at least current shareholders are, when the resolution actually happens.
Okay, brace yourselves for a rude shock when the resolution actually kicks in for some of these names that are already very volatile. It's been a lovely discussion. Thank you so much, Deepak, as well as Mr. Anthony, for taking time out and joining in, giving us more perspective on this space.